Well, welcome back, and thanks to the previous panelists for making a very dry subject, which is regulation, very interesting. I think it's been a signal part of today to see that we've taken some pretty dry topics and turned them into something that have been relevant and interesting. And I hope and intend that this panel will be no different. We have representatives on the panel of organizations that run, I did a sort of back-of-the-envelope calculation, and it's over $1 trillion worth of AUM from my assets under management from my panelists here, and both local and global. And really what we're trying to do with the next hour is to talk about how the global landscape for investment on the investment, the asset side of the pension balance sheet has changed, what that means for the way in which organizations, investment managers, asset managers, and pension funds need to deploy their capital, what are the risks, what are the opportunities, how a migration to a hybrid system between DB and DC might change the way in which regional pension asset holders, asset owners can deploy their capital. And then we're going to end up with a little bit of crystal ball gazing, where we look at where we all think the markets are going to be going over the next year or so. So the first thing I'm going to do is to ask my panelists to introduce themselves and say a little bit about who they are and what they do. So Alistair, why don't you start?
Yeah, my name's Alistair Byrne. I'm Head of Pensions and Retirement Strategy for EMEA at State Street Global Advisors, which is the investment management arm of State Street, and responsible for globally, there's about $3 trillion of assets under management at our firm, much of which is for pension fund clients. And my job is to advise pension clients, both defined benefit and defined contribution, across the region.
I should up my 1 trillion to 4 trillion then as a result of that, or 3.5, that should say, 3.75. We've already gone up. Markets are up already. We haven't even just started. Thank you very much, Alistair. Mark, could you just introduce yourself? Tell us, for those few of us who don't know who you are and what you do.
We'll do so. Markets are... On?
Yeah.
Yes. Well, markets are up today, so I guess our AUM just raised by a couple of basis points. So we nearly are at 4 billion BD right now, which is a nice amount. I work with Osol Asset Management here in Bahrain, actually next door, where we are the investment arm of the government pension funds.
Najla.
Najla Shirawi, CEO of SICO. We are a wholesale bank based out of Bahrain. We manage money on behalf of institutional clients, mostly sovereign wealth funds as well as pension funds. We are also a broker in the region, a market maker and an investment banker. So we provide advisory services to our clients. We manage around $2 billion, which is the smallest among the panel, but still a considerable amount of AUMs, or assets under management, considering that we invest on behalf of clients in only 2 classes, equities and fixed income, and all of these assets are regional assets, MENA assets. Thank you.
Thank you, Najla. Brian.
Good afternoon. I am Brian Clark. I am a senior manager at a small little firm called IFM Investors. It is a very unique institution in that we are an asset manager, an investment manager, global, and we are owned by and we're established by 27 pension funds in Australia. And we've taken that model to now manage capital for over 250 pension funds from around the world.
Thank you. And last but by no means least, Munia.
Hello, good afternoon. My name is Munia Harifi Touhami, and I'm heading the Middle East business for Macquarie Group. So Macquarie is an Australian bank, and we manage money on behalf of investors. Our investors are institutional investors, mainly pension fund and sovereign wealth fund, and we manage globally 500 billion of assets. But my division is specialized in infrastructure, so roads, toll roads, airport, and we manage 95 billion US only in infrastructure globally.
Thank you. So a variety of different types of people. Alistair, I'm going to start with you and really sort of kick off. We are 10 years now, not 10 years and a month or so since Lehman went down, commonly seen, although I'm not sure I believe it, as the sort of apogee of the financial crisis. The investment landscape globally has changed. How, tell us what your opinion about how it has changed. What's different now from the way that capital, pension capital particularly, is invested globally from how it was, say, 10 years ago?
I think the biggest issue has been a move into an environment which is very much a low interest rate environment, implications on the asset side, but also on the liability side in terms of discounting the liabilities. An environment where actual returns from growth markets, from equity markets, have been good, but expected returns have come down, and we really can't rely on the growth that we've seen over that last decade to continue in the future. So I think those are the big issues that have weighed on the investment side of the pension schemes. And away from the financial markets, the other thing that's been happening over that period is, life expectancy continues to lengthen, and again weighing on the liability side. So, really low interest rate, low expected return environment when the liabilities are getting longer because of the great news that people are living longer.
High quality problem, as they say. You're always going to have problems, might as well have high quality ones. Mark, it's not just a question of the market environments, is it? I mean, the structure of the investment industry has changed. How does that impact what you did at your previous incarnation at Blue Sky and now at Orsul, in terms of how you work, who you work with, and how you manage your assets?
I guess compared to 10 years ago, that's a big change for me, coming from managing assets for Dutch pension funds, where in exactly 10 years ago we were, just digesting the beginning of the global financial crisis, having a huge swap book against low rates, well-funded, but lots of worries. And right now here in a small country like Holland, very small country, but passionate people that want to live. And here we have a yield curve that starts with a 4.5%, and that goes up to, say, about 8-ish% for the long run. That's quite a luxury we didn't have in Holland. Obviously, there's a credit risk involved. But that's one of the first things that is the big change for me. That is, we have a different starting point. So instead of running a huge book of matching assets, we actually try to invest here. We try to invest and use the creativity of the capital to make more returns. And I would say that's one of the major differences between investing from a European perspective and or a more Western pension fund perspective towards the perspectives here, where actually the individuals are used to make deals, engage, and try to make more of it, of what's there currently. I would say that's one of the most striking differences I see here. And obviously, with my team, I try to help this, because we need a lot of coordination on this one. There's too much that can go wrong on one deal. So that means I want them to focus on what do we know, and that we can master these deals. So that, adverse selection kind of individuals also happening to be part of the financial industry, that they don't have a chance to get money from us. I want to focus on ownership, that we actually, on behalf of our clients, be the best to offer those services to them. Make sure that we safeguard what's theirs, that it remains theirs, and preferably a little bit more.
There's a lot in that, and we'll come back to that. Najla, from your perspective, I realize, relatively speaking, you're quite a small asset manager, but one of the trends in the global investment management industry has been the development of mega managers like State Street, Blackstone and BlackRock are the one. BlackRock particularly is the one that's always in the headlines, but also Fidelity and Vanguard. These massive multi-trillion-dollar funds who have hoovered up lots of passive investment. How does a smaller manager manage to compete? And where do you see yourselves fitting into this new landscape of these, huge global players?
Actually, the financial crisis, even though it was massive, it had an impact on different parts of the world, including MENA markets. However, asset managers within this region have really benefited from the financial crisis. We have seen inflows of funds towards regional markets because some of these regional markets gave opportunities for higher yields, be it on the equity side or the fixed income side. And the pension funds, I think, investment strategy has evolved since the financial crisis by looking at alternative investments, bets that are outside their typical investment strategy or asset allocation. So they were chasing yield just like any other investor in the market. So the mindset of the pension funds, I would talk about the region, the pension funds in the region have changed. So they were open to alternative asset classes, taking overweight positions in equities, and maybe taking some credit risk. However, since then, today, the situation has changed. We continue to see credit spreads tightening. Equities are almost fairly priced. So passive investment is not something that I think most pension funds are looking at. They are looking at active investment managers that would give alpha. Alpha is a ratio of performance. So typically these pension funds would look at the best of breed managers in any asset class to deploy money. However, in this time and age, it's more challenging to find the right asset managers, be it within the region or outside the region.
Thank you. Brian, I've talked to the points that the others have raised, but perhaps a more specific question. Financial investing is about risk. It's about managing risk. It's about knowing where your risk is. It's about taking risks. Risk is the underlying concept for much of it. Does the world's financial system, does the risks sit in the same place today as it did 10 years ago, or has there been a shift in the way that risk is held, and has it been away from one type of institution towards another? And what does that mean for investors if it is the case? Big question, I know. I'm
sure. So I'm going to tie that question together with your original question, which was all around to what extent has the world changed since the global financial crisis. And I would argue that sadly it has not changed enough. And by that I mean when you think about what happened during the global financial crisis, and in my market, in the U.S. market, there was a whole conversation between to what extent did Wall Street versus Main Street suffer through the GFC? And I would argue that unfortunately that is still very much the case. That those who are bearing the most amount of risk are those who are least capable of managing and taking on that risk. That the institutional players still protect themselves well and continue to push risk down to the least common denominator when they can. And those are the individuals who most need the protection. So back to your original question, I don't think enough has changed. That risk-sharing equation has not been modified in a manner that I think it should have coming out of the GFC.
Is it fair to say, I'm citing, there was an FT article a few weeks ago which went into some of the details on this, where it's like in 2008, 2007, 2006, a lot of the risk actually sat on the balance sheet of various banks, and they'd passed that risk around, often in the form of mortgage-backed securities. But since the GFC, the banks themselves have de-risked, but the asset managers, investment managers have upped the risk, which really means that the risk is sitting, as you say, with the end holders of those assets, the pensioners and the savers. Is that a fair thing to say? I mean, that in fact the risk has actually been pushed further down into the system. Whilst nominally on the surface the systemic aspects of finance may be safer, the risk is now being held, in people's pension plans rather than on the bank's balance sheet. Is that fair? Is that a reasonable comment to make?
That is a reasonable comment to make, yes.
Good. Okay. So, Munia, please comment on the topics in hand, but also, if you want to, talk a little bit perhaps about the role that real assets play in pension funds, because historically pension funds were more invested into the traditional equities and fixed income, and less into the private asset alternatives space. But there is a case to be made, of course, that the type of assets that you look at, long-term cash flow generating assets, are very appropriate for pension funds. So maybe talk a little bit to that, but also please give us your comments on where we are 10 years on.
Oh, thank you. So just to make a comment on Brian, I will very much agree with him on the question of what we have learned from the crisis, what we have learned from 2008. I don't have the answer to the question, but it's still...
you need to speak very close to the mic. But speak, yeah.
It's still an open question, what we have learned from the crisis. The difference that we have seen in coming from pension funds is the growing interest into alternatives. And what we call alternatives is real estate, private equity, infrastructure, farms. So it's all this asset class, and we have seen numbers show that it was, I think, 11% roughly the asset allocation towards alternatives from a US pension fund was 11% in 2006. Now we are at 26%. So we have seen a growing interest in this asset class. And we, as an infrastructure fund manager, have seen a lot of people asking us interest in infrastructure. And I think for us, it has been the biggest change since the financial crisis.
Very, very interesting. Now, I'm going to ask you to put your hands up in a second. If you think that the financial system is safer than it was in 2008, put your hand up now. 1, 2, 3. If you think it is less safe than 2008, put your hand up now. It's about equal. There's still... And how many of you think it's about the same? Yeah, I'd say that was so. I'd say it's one of those absolutely useless things I've just done. It indicates absolutely nothing except there's a difference of opinion. We're almost equal, safer, the same, and more and less safe. Which means I think it's a classic financial markets things. No one really knows what's going to happen. So. We'll come back to that maybe a little later. Mark, please.
Well, may I recommend or comment on the just mentioned in terms of risk and risk being pushed to the lowest part or the weakest part of where people will end up with some adverse investments in their portfolios. Yes, that happened. But that's also why I would stress that with my team, I work on either we understand where we invest in or we don't. So even if someone comes to you and tells you that they have a phenomenal opportunity for you, well, let's dig into it and let's see what it really is. And still, if you can't bring it home in terms of what is it, I mean, metaphorically, most of the time I tell them, if you can't tell your grandmother what you're actually buying, or if you can't explain what it is, don't do it. Or invest more time into it. Mm-hmm. So I mean, maybe into complex things, you might have special skills. So invest in systems, invest in people, invest in your staff. And if you can't, fine, but then that's not an eligible investment for you.
So it's a question of knowing what you don't know. That sort of thing. We can get a Rumsfeld thing going here. Brian was putting his hand up first. Did you want to say something, and then Alistair?
So just one element where I think we've got it wrong, and by we I mean those of us who manage capital for the asset managers, is that too much of the profit is kept by us and not enough of the profit is pushed down to the underlying member. That misalignment is not sustainable in the long run. When, we have a rather simple philosophy, and I know it's going to sound a bit silly, but if you're a fiduciary, and we are fiduciaries, investment managers are fiduciaries, that means my responsibility is to try and maximize as best I can the overall performance that you as the investor receives. Well, there's only one part of your performance that I completely control: your fees. Your fees have a direct negative effect on your performance. It, as a fiduciary, should be my responsibility to try and minimize what that fee take is. And not just the fees that we capture, but the disintermediation of all of the fee takers all the way through the system, from the trader at the floor to the execution agent to the custodian to the manager who's making a decision. All of those fees are taken out of the individual member who ultimately is waiting to get an appropriate retirement. That's got to change. And that dynamic is beginning to change happily, and you all are starting to force it happily. But that's a misalignment that I see as a real negative that's taking place right now.
Well, my Dutch background, I mean, metaphorically speaking, there are some people that say that the Dutch always want to sit for a dime on the first row. So that's well taken care of. But also, it's not about not saving as much cost, but it's also the reason for investing that amount of cost to get access to the good returns. That's what I would like to stress. I mean, we're always we're ending up towards the end of the year. We need to do the budgeting for next year, and we always ask a little bit more for what we had previous year. Of course, that's what human beings doing. But predominantly, I always ask, and a lot of my staff members are here, my colleagues. I ask them, tell me why you want this. And if they can answer, and we have a good explanation for it, then I can easily go to my board and say, well, I think this is a good thing that we should do.
Alistair.
Yeah, and just to round off that discussion on cost, what we see from a number of clients is a core allocation to passive in order to reduce cost, but to free up budget for active, for alternatives in areas where they think it can really add value. So it's not an either-or discussion. There's a place for both, and it's about thinking of a fee budget and how you spend that most effectively. But the point I wanted to make was about risk. We've had quite a negative connotation of risk in this discussion already. Think about it from the member's perspective. Many pension savers have a long-term horizon. What we really want is for them to be taking risk and participating in the growth in the economy through the financial markets. So, we shouldn't focus too much on short-term loss. We should have pension savers, firstly saving enough, and secondly putting that capital to play in the markets to get the long-term benefits. And if there are some ups and downs along the way, then for many of those savers that will be irrelevant compared to the better ultimate outcomes that they will get over the long horizon. So, let's not be too negative.
No, sure. I mean, absolutely. No risk, no reward. I didn't mean to say that.
I have one comment on cost. So the cost at the fiduciary asset managers is one thing. However, the cost of running the very fragmented pension funds in the region is humongous, because we have a pension system that caters for different type of workers in different sectors, and that yielded over the year many very small pension funds in the region operating as independent pensions and just replicating the entire structure of a larger pension. So when these smaller pensions invest, they invest small. Naturally, the cost that they will incur on smaller investments would be higher than the larger pensions. So if these pensions just consolidate, will create economies of scale, cost will be reduced, investment strategies will be better, diversification outside the region will be enhanced, because today these smaller pensions can't recruit talents. They can't afford to recruit talents. So their universe investment universe is very limited. And even if they rely on the very large global asset managers, they don't count because of their tickets, the size of their tickets.
So you would advocate for one of the parts. I mean, we talked this morning about the world pension reform journey was the title of the panel that I did. But you think there should be a consolidation amongst pension funds in this part of the world?
We start with consolidation, and then we look at basically the situation in these pension funds once they are consolidated, whether we are underfunded or the benefits that we have are these benefits that we can guarantee for the long term, or we are just passing the burden to the new generation, and whether from the returns that are prevailing in today's market, we can sustain such benefits on the long term.
Thank you. Mark?
Yeah, the consolidation is always a kind of a hot potato. Why? Because with consolidation, most of the time you also cut away a few individuals that have a happy job right now. So that might be, with decision makers, might be a hard decision. But first of all, we could start with cooperation. I mean, we're not competition to each other. I believe actually IFM International, I mean, being founded by 27 of them and basically aligning 27 institutions to invest along, and perhaps, I don't know too much about it, but with a bit of alignment, you can easily enlarge the size of the tickets that you can write, immediately lower cost. And maybe one of the institutions has knowledge about a certain asset category that we don't have right now, so there would be an enormous benefit to all of them. And not being competition to each other. I mean, I don't compete with my other pension fund on the return that we can achieve. It would actually be a good way to team up.
Okay, Brian, and then Munia.
Yeah, I was going to say exactly that, Mark. Our history is one where 30 years ago, those pension funds that I described literally understood that a wall of capital was going to be coming their way over the succeeding years, and they did not have the capacity to manage that in the way that the global markets would pay attention. So they created us, and we're called a collective. It's a collective of like-minded institutional investors who took their capital, pooled it together, and forced the markets to bend their way from cost perspective, from transparency perspective, from ticket size, all of the above. There's nothing that holds people back other than, some level of, well, I got to do it on my own. A lot of what you do can, in fact, be done better from a collective perspective.
Munia, sorry, you were nodding there.
Yeah, I would very much agree with that. I don't know if there is anyone from Oman in the room, but Oman, for instance, has 11 pension funds, and us, when we go and visit them, we visit maybe 4 or 5 in one day, and they're pretty much all doing the same thing in the same country, actually. So they use external consultants to do their asset allocation, they invest in equity, fixed income, and they have the same program, maybe 4 or 5 over 11. So I believe that a kind of consolidation will help the country and the pensioner at the end.
I mean, initially, probably within countries, a cooperative element within countries rather than cross-border. God, I wouldn't know. I mean, the cross-border cooperation has never been brilliantly done in the GCC. But I mean, would it be better for you as a manager? Would it be more efficient? Would you be able to offer a better service if, rather than 11 pension funds in Oman, there was one? Because you could give them a more competitive price and... Is that,
one, or I would say maybe 5. From 11, at least 5. I guess it will be more efficient for the country as well, in terms of performance, rather than in terms of fees, it will reduce the fees. So I can only see benefit of at least reducing the number of pension funds.
So I would put one kind of qualifier to that, and that is, for a collective concept to work successfully, the manager needs to take responsibility of not seeing one investor, but all 11. Because it's only through that knowledge transfer over time, that true partnership over time, that each of those 11 institutions will grow, they'll mature, they'll become more sophisticated. And if you close the door to that conversation, if you close the door to that education, you're basically saying you are what you are and always will be. And that's not a fair proposition. So yes, it puts more onus on the manager, but that's where it should be. It is our responsibility to educate, to share, to be transparent, to bring them into a place where they become a more sophisticated individual institution.
Mm-hmm. Anyone else want to comment on that before no, good. So Mark, I'm going to come to you on this one. This is a little bit of not so much a hot potato, maybe a warm cabbage or something like that, but pension funds, so last week in the FII in Riyadh, amongst other things that were announced were two significant investments by Hassana, the public-private pension plan in the kingdom. One to invest 800 million in healthcare, and the other a similar amount into education projects. There was also announcements, I think, from another. Okay, well, let's just stick with that. There is a feeling in this part of the world sometimes that these assets should be used to help development here in the region or in the country. There should be a sizable allocation towards local assets. And I don't just mean local equities or local fixed income or sukuks or whatever. I'm talking about physical, real estate or companies or things, which is, how we say, aligns with the developmental objectives of the country. I don't want to say politically directed because that implies inappropriate, which I'm not saying. But they're saying, these are our assets, this is our capital, we should be using it to develop us rather than, giving it to Brian to, buy an airport in Manchester. How do you navigate that as Osul? Where do you think the line lies between local and global or regional investment?
Well, in general, investing in schools as a business model can be an attractive business model if there's a growth or there's a growth in that local economy to be captured. So if we would invest globally in schools, why couldn't we invest locally in schools? So it just comes down into, again, the reasoning of why do you want to put a school over there? And if it is to educate a certain part of the population and bring them up so that they can actually be for a greater value of the country, phenomenal thing, good thing to do. Now the thing is more like, how do you want to do this? Because basically, we're not school teachers, so we are not in this sense the operators. We have capital, and we could actually provide for either land or the property. And we're happy to hold it. But we always need an operating partner to be able to put there a school which is up to standards. So our interaction will be with the operators saying, well, how good are you in operating these kind of schools? How are you going to be aligned with the direction of the government, what they want to achieve? And the same holds for healthcare. Right now, what you see is coming up more and more globally, that is elderly healthcare. With the aging of the population, there's more and more demand for these types of healthcare. So that could be a perfect area for us to invest. And not like a private equity investment where we would shoot for the highest returns. No, it comes into an infrastructure bucket, where we would say running yield instead of investing in a bond. Whereas where the government would invest that kind of money to do those kind of things, we can invest that.
But the decision to make that an investment, is it based on financial returns, or how do you, where do you have that balance between social and financial returns?
No, number one is financial. Up and foremost, in the end, we invest money on behalf of the current workers and retirement beneficiaries for later. Yeah? So they are relying on that amount of money. We're not like an ATM where someone can call upon saying, well, we need a little bit of money to do this in XYZ and we will see what the returns are. No, there needs to be a business plan. Definitely.
Okay, sorry, Alistair, you wanted to...
Yeah, I was going to come in. So take the point about financial first. We've been talking today about defined contribution. We've been talking about engaging members. I'm just going to hold out the prospect that if a scheme is investing in a local asset, if it's investing in a tangible asset that people can be comfortable with, if that gets people more comfortable with the pension plan, if it gets them to engage, if it gets them to save, then that's an additional benefit as well. So from a pure investment point of view, I'd be saying diversify globally, get into the public markets. But if there's an element of the scheme invested in a way that's more tangible to members, and that gets them saving, then that's a great thing, and I would strongly encourage that.
I mean, I'm going to sort of be slightly controversial here. I mean, there is a history in the emerging markets. This is not a GCC thing specifically, of this type of investment. So using state funds or state-associated funds for investments where the governance is substandard. I'm not even saying corruption or anything like that. I'm just saying the projects are not completed, they're not done properly. And then, because this is a sovereign-related investment, there's no workout. How do you set up a governance where, if you do invest in a project that has a local benefit, you can maintain the governance of that to ensure that that project is delivered successfully? You're nodding, Mark. Do you want to talk to that?
Well, it's happening every day. And again, for the same example, to put down a school, we're not builders either. Construction is not our core asset. So we would rely on parties. So, for instance, on the project, we would rather invest when it's turnkey, so that we don't bear the risk of constructing and all these kind of things. Mm-hmm. To put it in an infrastructure bucket. Otherwise, I would put it in a venture bucket, where there's higher risk to it, yes, and I demand a higher return for it. Well, for instance, I believe the gentleman here on the first row, he mentioned trust being a very important part.
That was my next question.
Yeah, well, the thing is, if I start giving away money or giving away return to someone else, then the trust goes, and probably the trust goes very fast. And it takes a very long period of time to regain that trust.
Yeah, trust climbs the stairs and goes down in the elevator, rather like the equity market. So, Brian, I want to keep with trust, because this word trust has come up in every single panel in different ways. How does an asset manager, a pension fund, build trust with its with its pensioners about the investments that it has? I mean, this has been a theme all day this morning. As we don't really trust the government, we don't really trust the pension fund, we don't trust the system to act in our best interests. Now, there's no question, no one's saying that the pension funds have been acting against their interests, but that's what they think. How do you go about building trust with the eventual beneficiaries of the investments that you make?
So this is going to sound a bit trite. Trust is earned. It's not automatic. And you earn that trust by doing a variety of things that are relatively simple. You're open and honest at all times, not just when it suits you. You don't just tell the truth and be open and honest when things are going right. You need to inform your investors when things are going wrong, but you need to tell them even before things go wrong so that they're prepared and aware of what's going on in the marketplace. You need to be fully transparent about what you do, how you do, and why you do. You can't, again, make those decisions on a discrete call of, oh, it suits me to do that now. So the whole trust equation, I think, is one that is seriously not spoken of enough at institutions. You've got to have a dialogue about it. You've got to think about what it does it really mean, and how do you capture and earn and maintain that trust all the way through the life cycle of the relationship that you have with your investors, not just at those moments in time when either it suits you or it puts you in a better light. So it's a complicated question, and one that institutions, I think, don't spend enough time worrying about.
Munia, I want to ask you the same question. I mean, obviously not, but it's about the trust between the investment manager, that's you, and the asset manager, that's Mark. I mean, unlike Brian, you're a private company, you exist, and there's nothing wrong with that, to make profits for your shareholders. But there has been sometimes a little bit of friction between asset owners and investment managers. So how do you build trust with those or the people that you're deploying capital on behalf of?
Well, that's a good question. And I think especially in this part of the world, trust is very important. But as Brian said, trust is earned, and it takes time to build trust, to build relationship. But it's the foundation of any partnership with our clients, investors, or counterpart, basically. So for us as an asset manager, it's more important to earn trust and relationship first than closing a deal. And usually we prefer, it's both way relationship, so we prefer to have trust and relationship before doing anything. Because especially for us, it's a very long-term approach. So we have funds for 10, 20, up to 25 years, basically. So if we go on a journey, we better get along, basically. So for us, it's very important, trust and relationship on a long-term basis.
Najla, you're local. You see everybody you're seeing Mark for coffee every 25 minutes. You're there, you play tennis together or whatever. I'm making this up, by the way.
We're shareholders.
You're shareholders, even closer. There's that. You're part of a community, but a lot of asset managers are coming in from outside. They maybe just fly in. They do that. How do you compete? How do you position yourself? How do you build trust as a regional institution rather than a global one? How do you position yourself differently?
We compete on merits, actually. So unless our performance track record makes us stand out as a top quartile asset manager, unless we have total transparency and we are happy to share all our workings of performance figures, of our even rewards to our investment management team, how we reward them, how we return them for the long term, what corporate governance we have, what control framework. So we are happy to share that with any client that would like to have due diligence on us. So in terms of how we compete with the asset managers, I think we are a niche asset manager because we are looking at the region. It is our focus. This is where we built our capabilities for more than 20 years. So in terms of competition, I think throughout the years in this region, we have seen many corrections, many crashes, market crashes. These markets were undeveloped at a certain point of time. They are not fully developed yet. They are evolving. They are improving. However, throughout these market crises, crashes, wars, we had an increase in AUMs. We did not have a dip in AUMs. And that differentiates a good asset manager from a bad asset manager. Because if you lose AUMs when markets are really attractive, then it means that you don't know what you're doing.
Alistair, I'd like to, your comment on the trust thing. There is and I think it's a little unfair, but there's an element of truth in this. You're an enormous organization. You manage, trillions of dollars. There can be this idea that your type of organization is so huge that the Middle East is really, with the exception of ADIA, KIA, QIA, and possibly SAMA, it's all a little bit too small. The people don't really spend time building the relationships. Is that a fair thing to say, or do you feel that trust, even for someone of your scale, is still a very important commodity?
Trust is a crucial commodity. I have to defend myself as someone who has flown into the region for this conference. But
so have I. That's all right.
For us, it's a balance. So it's about having global centres of excellence that have economies of scale in managing the portfolios, but also having people on the ground in the region who are building relationships and can be here for the long term and build that trust through the consistency of the relationships and the consistency of what they deliver. So it's very much a balance. For us, the region is very important for us. We've been investing, we've been opening up new offices, we've had people in the region for many years. So it is attractive to us, but we understand that we can't just kind of fly in and fly out, and we need some boots on the ground. Otherwise, we won't get the same trust as local managers, and we won't be successful.
Thank you. He's just thrown me complete. Ibrahim's just telling me to stop. Okay, I've got one more line of questioning, and then I want to take some questions. Just give me 1 second, because this is the title of this conference is to do with DC. So can we just quickly understand that if and I'm going to start with you, Alistair, and we'll go down at the speed of light, otherwise the boss will be cross with us. If the Middle East, or the MENA region, begins to move to a hybrid of more DC as opposed to DB, what does that mean for the way in which they invest their money? Will that have to change as well?
Firstly, I think the DC move is inevitable. Don't pin me down on the timing, but if you look around the world, state-based defined benefit plans have become less generous. Corporate plans have moved from DB to DC, so I expect it will be a trend. I don't think there's a fundamental shift in investment. The principles we've talked about, you need to be diversified, you need to manage your costs, not to say it's the lowest cost, but you need to be careful that where you spend money on management, you're conscious that you're going to get a good return on that, whether it's active, whether it's alternative. So I think principles of good investment still apply, principles of trust still apply. We need to be transparent to the members, and we need to be conscious, most of all, that they're not investment experts, so we need to package things up in a way that are easy to use and that are well governed, and not rely on them making the detailed portfolio choices, because I know of no market in the world where that's taken place.
Very good point. Mark?
I agree on it. There's a movement towards defined contribution. That said, there's a transfer of risk accompanied with it, because that's the cost. And risk and cost are two things that we should keep a clear eye on. So if we do things together and align, then we can keep risk and costs at a good level, comparable to DB, whereas we have more involvement of individuals. However, given the current situation, keep it as collectively as possible. And if the individuals feel that they need to do something extra, do it on top of it.
Yeah. Okay. Najla? I mean, will DC change things, the way the business works?
It will change, certainly, the way asset managers look at their services and the projects that they show to their clients in the region. So far, we've been always looking at the plain vanilla type of products. I don't think there are many regional asset managers that have the sophistication, especially if they are investing in the region. I think the asset management industry will go through consolidation. It will enhance certainly the capabilities because if there are more funds, certainly there will be more interest to expand.
Brian?
I would throw out a bit of a cautionary note, and I kind of refer back to the prior panel that was talking about the regulatory environment that needs to be created when you do a DC plan. And I think about it, looking at it from a global perspective. In Australia, as was noted, in Australia, the vast majority of capital managed for pension recipients is in a DC plan. And they have figured out how to still deliver to those individual members an illiquidity premium. So they're able to invest in private equity and in infrastructure, in real estate, in illiquid assets, and capture that premium return that you can secure from those illiquid assets. Conversely, in the world's largest market, the United States, DC plans are incapable of investing in illiquid assets because the regulatory regime requires a liquidity and a pricing mechanism that prohibits, basically, prevents them from investing in those assets. That's a great shame. That really is a great shame for those underlying members who now can't capture what should be a better return ultimately for them. So as you're thinking about it from a regulatory and a structural perspective, make sure that those individuals that you're serving continue to capture the world's best investment opportunities and don't preclude them from capturing a very significant part of the investment spectrum.
Munya.
Yeah, it will be a great change from DB to DC, but again, when there are changes and disruption, it's also opportunities. So as we think together, I think we could see that as an opportunity to have new players, to know more about the market, actually. So it could be seen as an opportunity.
Thank you. Right, questions quickly. There's a gentleman there and a lady here, and a gentleman there as well. So we've got 3 questions, 1, 2, 3. Start 1, 2, and we'll finish with you, sir. And if you could make it quick as a question before I get dragged off the stage by Ibrahim. And we're keeping everyone from lunch, so please, sir.
Yeah, my name is Majid Ghamish, Engineer Majid. Thank you for the panelists. And you said it's focused on the direct contribution in this session. I just want to focus on the investment. I mean, when we go on the principles, the language of investment is risk, and the language of finance is guarantees. So we want to define which contribution that we can go on investment, and what sector and what level of degree of risk the investment funds or managers, they will decide to take as a policy. Now we are talking about investment, and there is investment responsibilities. The UN already issued the United Nations Principles for Responsible Investment. And all the state members in the UN, they signed on this. So we don't see any investment opportunities, funds, pensions, and so on. They focus on this kind of UNPRI. This is the main issue. Now we are talking about green economy versus the brown economy. And the green economy, already there is a very big study is made by the United Nations Environmental Program. And it covers all the sectors that goes with the green economy, from the building materials and so on. And in parallel, we have also the Sustainable Development Goals. And that Sustainable Development Goals that will last for 15 years is focused on the environment. And the environment is the third part out of socio-economic. So now, in these 17 goals, also there is what you call it, the innovations and other things. So what is the policy of the pension funds to contribute in such kind of investment chances, and what kind of degree and what kind of sector? Thank you.
Thank you very much. Good question. So ESG. I'll start with Munya because I've always been starting this end. So Munya, what about how does ESG fit? And if you can do it in a couple of sentences, how does ESG and that type of investment fit into what you do at Macquarie?
Well, it has been, I mean, we have heard a lot about ESG over the past 10 years. We have actually now people dedicated to ESG. In Macquarie, we have probably globally around 10 people, so it has been a growing focus for the company. And also in our fund, it is a key topic today that we are trying to focus on and to work on.
Thank you. Brian.
So ESG has been woven through our very fabric. It's part of our DNA, and it always has been from the 30 years that we've been in existence. And we don't do it because we like to hug trees, per se, although that's a lovely belief. We do it because it's good business. It's good business to manage yourself from a perspective of ensuring your environment is in a safe holding position. It's good business to ensure that your labor, that your social, your stakeholders are happy and comfortable with what you do. It's good business to ensure that you're governed appropriately and responsibly. So for no other reason, it should be a fundamental of who you are and what you are. So for us, it starts with the very investment thesis that we start from. Why do I want to invest in this company? Because it's got good ESG. How am I going to manage it? Because I'm going to be thoughtful about the sustainability of that company. How am I going to sell it? I'm going to sell it to a responsible owner if and when we do that. So it's woven through everything that we do.
Thank you. Najla, are your clients, mean, historically, it's not been a great issue in this region, ESG. Are people becoming more alive to it and insisting
Yes,
that
certainly. I think there is a big move towards ESG. It's not just for asset managers, pension funds, or just in terms of investments. It's also in terms of all our other banking operation. So we started looking seriously and taking the issue more seriously. Even as a member of the Bahrain Bankers Association, we have issued a code for the banks in Bahrain to follow, at least as a start. However, the concept, I would say, it's quite new. So if I go around in the GCC, it's not very much there yet.
Mark, do you? I mean, as someone from the Netherlands, presumably that ESG is, if we cut you in half, you'd have ESG written inside you. But have you brought it into what you do at Usul?
Well, previously being investor on behalf of the Royal Dutch Airlines, I guess that's not a very ESG company, although they top the ranks being
the least environmentally catastrophic airline.
That's the thing. I always had a big debate with my pilot scheme where they said, well, what do you think that happens if I go on with my Boeing 747 and I go full throttle? What do you think that happens in the back? And so we had ESG discussions there. No, but undeniable, it is a big thing. I think indeed we are here just at the first footsteps of implementing it in our investment strategies. And that's actually where we are with Usul as well, with our clients. The pension funds do not have a top-down policy on ESG yet. Why? Because it's complicated. It's not easy from say, high over ambition, for instance, to lower emissions. That is nice, but how do you implement that in your portfolio? So this is where we think about, and again, this is at the infancy of those steps. Undeniable, it is a movement; it will come through, and for now, we take it more by the opportunity that if there is a certain reward to be reaped from the markets by investing in ESG or specific ESG-oriented managers, we won't shy away from it. Actually, we would have a preference to do so.
Alistair.
Yeah, an area of significant and increasing interest for a global client base. So I would echo that the European asset owners are probably ahead, but we're seeing it across a number of regions. Increasingly, the discussion is around the impact on risk and return, that you create a better portfolio by taking account of ESG and investing responsibly. And we're seeing increasing interest, particularly in defined contribution schemes, because as well as the risk return element, you've also got the member engagement element. Members want to know that their capital is being invested responsibly. I've actually seen research that they can get quite upset if they realise that the portfolios are not taking account of that. So strong trend in a number of regions, and again, I would expect it to become more of an issue and more of a focus here.
Mark, you would?
Yeah, exactly. I just wanted to add a little comment because what Alistair just mentioned. One thing that we also focus on is stewardship. That means we select managers that manage parts of our assets on behalf of our clients. So when we select those managers, we also look at how do they go along with selecting the companies that they invest in. How vocal are they? Do they vote, for instance, at certain AGMs when there are controversial items on the agenda? So that's parts of on the operation that we do, and I think it's actually very important that these things happen.
We're pushed for time, Brian, but quickly.
I would only close this topic with one quick comment, and that is every single person in this room has a responsibility to be thoughtful around this issue. And I say that because as we're witnessing a growth in populism globally, this can become squeezed out of the conversation. I don't know to what extent anyone in this room is aware, but just a few weeks ago, the president of CalPERS, the largest pool of capital in the United States, was just lost her re-election to that position by an individual who ran on the principle of killing the ESG conversation at CalPERS. It's all about returns, was his argument. It should not be about ESG. That's a dangerous precedent, and it could easily become a wave across the global conversations if that were to become unleashed.
Thank you. There was gentleman wants a question and the lady there. I'm going to take both questions one after another because I'm getting the eye. So if you could make it a question, that would be very good.
Yes, and it'll be very quick. My name is Amy Curley. I work for STM Group, and we are the trustee of DC pensions in Malta, Gibraltar, and in the UK. And we're increasingly seeing regulation require that we only invest in certain assets. And to Brian's point earlier about in the United States, we see the same thing. My question to you all is whether or not you feel that this concentration in certain types of assets actually increases investment and market risk, because I think it leads increasingly to global volatility in certain asset classes, and I'd love to hear your opinions on that.
That's a great question. Thank you very much. And this gentleman in the front, if we can have your question as well, sir, then we can try and deal with them both quickly. And if you could make it a question, that would be fantastic.
Last one, okay, please. Actually, it's a very useful sitting, and we are happy, me and my colleagues, the retirees, listening that there is opportunity to have investment schemes. Actually, young ladies, Najla and Munia said that their expensive capital is 500 million. And also she's looking for new investment. Najla has 2 million and she's looking for expert to invest this 2 million. We will give them this positive participation. I can guarantee for them from our retirees, the GCC, about $20 million to invest it if they give us a clear and secure scheme. Can guarantee that. There are people here from all GCC retirees. And second, there is now in Bahrain, within 2-3 months, the government going to spend, our government, going to spend about 10 million package for, say, about 20,000 voluntary for retired scheme. So let's think how we could achieve from this opportunity for those new retirees coming to the market. Please, this is Najla.
Okay, we may have to do that on a bilateral. It's a good point, but I'm not entirely sure I understand exactly how that would work. I want to just pick up the concentration risk point, and do the final question, which is really, should we be worried about the markets, which is a sort of similar thing to what you were saying, not quite the same. I'm going to go down the line. Alistair, are pensions and other people too concentrated in certain types of assets? Should they diversify? And are you worried generally about where we are in the financial markets? Do you think this wobble is a wobble or the beginning of something worse?
Yeah. So part of the question was about financial restrictions and regulations, and I'm generally against very prescriptive regulations on asset allocation and investment mix. The regulation should be about suitability and appropriateness, and the trustee or the fiduciary should be required to justify that the portfolio they have is suitable and appropriate for the beneficiaries in the market conditions, rather than the rigidity of a regulator setting very precise guidelines. In terms of the market outlook, rates are rising, equities have been in a number of markets quite high. There are certainly risks there. I think the bigger risk for pension investors, younger members, is not being in the markets for the long term and not saving. So that's my focus.
Yeah, well, surprising that an asset manager would say that, but yes. No, you're right, Mark.
Coming again from the European perspective, where regulators were looking at the risk of pension funds, and all of a sudden everybody went long duration and they're all buying into long interest rates. That might be dangerous, specifically if you're then caught by a suddenly rising yield curve. That might be a problem. For the rest, I don't see very much where regulators are imposing on other investments any regulations that would increase our risk, I would say. And if so, again, we would also hire managers that should have a focus on this one. Sometimes I actually like to have concentrated portfolios, because sometimes there's a good benefit to it. But you deal with specialists here. So sometimes it's also good to have a few of those specialists in there that really chase those returns, and when they're over, that they move on. We don't need a regulator for this, and maybe to actually exploit some regulators' kind of fallacies.
Najla, sort of, and also by all means, a quick word on the markets and where you see them.
One. To me, the regulators or the government should not manage the risk. The asset managers should manage the risk. So I don't see why there should be any restrictions there.
I just put out a word of caution, and that word of caution is if you're too concentrated in a particular market, particularly your local market, you may receive some risks that you're not fully appreciating. And I point to, for example, in Korea, where the pension funds in Korea actually own the majority of the equity market. That was fine during accumulation phase, but now that they're an aging population and they have to start selling their holdings to be able to pay their beneficiaries, they're in a position of potentially crushing their stock market by unwinding the positions that they have. That's not a healthy position for anyone, either the market or the pension fund. So be cautious about what concentration risk prospectively in the future may mean for you.
Munia, you have the final word.
I will finish by a quote, then don't put all your eggs in one basket. Diversification.
Very good. Okay. Thank you all very much. Thank you all for being so patient and waiting till nearly 3 o'clock for lunch. Let's all give ourselves a big round of applause and go and eat something. Thank you.